In episode 3, we have already established that ethical responsibility is the backbone of democratizing business valuation. Accessibility alone is not enough. Without independence, disclosures, and integrity, democratization risks becoming distortion. Valuation is more than numbers. It is stewardship of fairness. When assumptions are managed to fit a deal, or when pressure is applied to bend outcomes, trust is eroded. And without trust, democratization fails. To bring these principles to life, let's examine four case studies where ethical responsibilities is tested in practice. One, which is the terminal value and SLTGR. Second one is brokers' request for low valuation. The third one is contested share transfers. And the fourth one, which is shareholders' threats and cohesive tactics. Now, each scenario shows how the ethical valuation protects stakeholders, strengthens governance, and builds confidence in capital market. Let's explore how integrity guides practice in this complex situation. In case study 1, terminal values is often the largest component in a discounted cash flow model. The trigger here is the sustainable long-term growth rate, the SLTGR. Now, the ethical issues arises when growth assumptions are inflated to achieve a desired valuation, undermining independence. The correct assumption is to anchor SLTGR to macroeconomics reality, such as GDP plus inflations, and then adjust for firm size and industry dynamics. The implication after valuations are clear. If assumption lacks transparency, auditor pushbacks, founders disputes results, and the investor lose confidence. In case study 2, in capital raising, brokers may request a lower valuation to make rights issues or convertible notes more attractive to investors. The ethical issues is that minority shareholders face dilution, and the valuer's independence is compromised if inputs are managed to fit the deal. Assumptions often manipulated include lowering the WACC, capping terminal growth, or selectively applying level 3 inputs. Now, the implications after valuations are serious, such as shareholder disputes, governance challenges, and the reputational risk if the valuation is seen as biased. In matrimonial disputes, contested share transfers create valuation challenges. The trigger is ownership uncertainty during divorce proceedings. The ethical issues is neutrality. The valuer must avoid bias towards either spouse and disclose contested ownership clearly. Assumptions should reflect actual ownership at the valuation date, and in some cases, separate scenarios may be required for pre-transfer and the post-transfer position. The implication of the evaluation include court challenges, settlement negotiations, and the family disputes that can affect acceptance of the valuation. After a valuation report is issued, clients may disclose cohesive tactics, such as threats of major shareholders pulling fundings, winding up the company, or even sacking the CEO. The ethical issues is independence. Lowering valuations under pressures breaches professional integrity. Assumptions must reflect facts as of the valuation date, and adjustments made under coercions are unethical. The implications after valuation includes governance disputes, minority oppression claims, litigation risks, and the reputational damage for both the company and the valuer. Through these case studies, we have seen how ethical responsibility is tested in valuation, whether in terminal value assumptions, capital raising, matrimonial disputes, or even shareholders' coercions. Now, the common thread is clear. Independence, transparencies, and disclosures are the safeguards that protect trust in democratizing business valuation. If you found this insight valuable, don't forget to like, subscribe, and share your thoughts in the comments. Your engagement helps spread awareness of ethical valuation practices and builds a stronger and more transparent business community. Thank you.